Welcome back to another episode of Money with Jacob, coming to you every Wednesday at 5 p.m. Eastern Time. I was doing these every Tuesday and Thursdays at 5 p.m. Eastern, but we have a new scheduling time on here. We are now doing these every Wednesday at 5 p.m. Eastern Time. So if you've been around, you know how this works. I'm not a financial advisor. This is not financial advice. In fact, I have no financial license of any kind. All I have is a simple philosophy to build wealth, which has got me to where I am today, 28 years old, over $750,000 in a stock portfolio, and 100% debt-free. So if you got any money questions, be sure to send them in. Email me at jacobbuildswealth@gmail.com or leave them in the comment section below. I'll take comments, questions from the comment section too. Got no problem with that. So today, kicking off, we got two questions coming up. Both of the questions actually came from the YouTube comment sections on other videos. So number one comes from Sean. And Sean writes, as a first-time investor with $10,000 to invest, should I dollar cost average DCA my way in at this point? Or, he didn't write it. The other alternative is to lump sum your way into the market. Just throw all $10,000 into the S&P 500 and let it ride. Which one is best? Well, Sean, you know the old saying, damned if you do, damned if you don't. That's pretty much how I think DCA and lump sum investing kind of works. It's like if you lump sum in, the market's probably going to crash 50%. And if you dollar cost in from here to now, it's like it will just do a slow grind upwards of 20% for the next 2 years. It just seems to work out that way, right? But if it were me, I would lump sum it in. I would just throw all $10,000 into the market. There is data that shows that lump summing beats dollar cost averaging. So first piece of data I got comes from Vanguard, and it says that 68% of the time, lump sum outperforms cost averaging. So it's going to be better for you to just put your money into the market, and then for the rest of your life, whenever you get paychecks, start dollar cost averaging in. But with the lump sum you have now, you should just put it in. 68% of the time it works, but that does mean that 32% of the time, dollar cost averaging works better. And it really just comes down to timing. And unfortunately, we can't see the future. So I got a little bit more data coming from us from Morningstar. And they have two charts. One is lump sum investing versus dollar cost averaging just before the financial crisis. But then also the other one is the last decade, so during the dot-com bubble, through all the way up to the financial crisis. And they have two different colored lines here. They have a hard red line and then a lighter red line, and then a hard blue line and a lighter blue line. So the red lines are LSI, that is lump sum investing into the S&P 500, or the lighter shade of red is dollar cost averaging. So just comparing lump sum investing or dollar cost averaging into the S&P 500. And the blue lines are for lump sum investing if you're doing a 60-40 split of stocks and bonds, but we're going to ignore the blue lines. So it shows that if you were to lump sum invest into the market, into the S&P 500, right before the financial crisis, going into 2008, 2009, lump sum investing, $100,000, around $100,000 invested into the financial crisis, and then all the way to about 2017, 2018, that would have been worth $100,000 up to about $250,000. Now, on the flip side, if you were to have dollar cost averaged into the market, you'd put in your $100,000, or dollar cost averaged it a little bit at a time over the time frame of 2009 to 2017, and your total $100,000 would be worth just a little over $200,000. And the reason this is because coming out of the GFC, the stock market had a great bull market. It had a great rally. So it's like you lump summed in at a perfect time. And in this case, lump sum investing works. But if we go back to the 2000s, which is one of the worst decades, maybe the worst decade on record for stocks, it's called the last decade. If you were to have lump sum invested in 2000, right at the top of the dot-com bubble, put in $100,000, by 2002, the end of 2002, it was worth about $60,000. You watched over 60% of that get cut in half. By 2009 at the financial crisis, that $100,000 was only worth about $70,000 to $80,000. It was the last decade. Vice versa, if you would have dollar cost averaged your way in, you could have put your first investment in around 2000, your first investment of $100,000, kept dollar cost averaging, and by the time 2009 came around, you would have had just a little over $100,000. So in that scenario, dollar cost averaging into the market would have been better. So ultimately, it just depends on timing, and unfortunately, we don't know what's going to happen in the next 5 years or 10 years. Are we going to have the greatest rally we've ever seen, or are we going to have another lost decade? So personally, what I think is when in doubt, zoom out. And here's a chart of the S&P 500 from 1981 to now. The S&P is up 5,000%. It did not care if you dollar cost averaged in. It didn't care if you lumped summed your money in. It's up 5,000%. So I don't think it really matters what you do, Sean. I think the most important thing is you just get into the market. If you feel better about dollar cost averaging, dollar cost average. If you feel better about lump summing, lump sum. If you don't know what to do, just meet in the middle. Why don't you lump sum $5,000 now and then just dollar cost average $1,000 a month for the next 5 months, or $500 a month for the next 10 months. Do whatever you want. Just get into the market. That's all that matters. So that's it. All right, moving on to question number 2, coming from Jesse. Jesse also commented on another video of mine and asked, what's your input on ChatETF? So Jesse, thanks for this one. I've never heard of ChatETF. So I did have to go do a little bit of research for this one. And first, what I did is I came to TradingView. I love coming to TradingView, looking at the charts on here. So I'm looking at ChatETF on the monthly chart, and it doesn't have a whole lot of data. Right now, the ETF is trading at $67.53. And it kicked off at $26 in May of 2023. So we're up just a cool 156% in 2 years, a little over 2 years' time. Not bad. But to be honest, the name Chat ETF, I see it up at the top. It says Roundhill Generative AI and Technology ETF. It launched in 2023, and we're now in the midst of what is the AI rally kicked off by ChatGPT. And this is Chat ETF. My spidey senses, this is when they start tingling. I'm an anti-get-rich-quick guy. I'm an anti-excitement guy. I like my investments to be boring. I like to not have any excitement at all. I don't want my heart to go up. I am very anti all of that. So my spidey senses are tingling. We got Chat ETF and basically what is the ChatGPT rally. It just launched a couple years ago. And this is when I start to think back to one of my favorite quotes ever of Charlie Munger. And he said, "It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent." I'm always focused on just trying to not be stupid. I don't want to make the best, greatest financial choices of all time in terms of like, that gets me the most money. This is the most exciting investment since we've seen in 20 years. I don't want any of that. I just want to not be stupid. And whenever I see that there's an ETF called Chat AI ETF in the midst of a bull market that just got released, it feels like that's probably going to be a place I'm going to lose my money. But I went on ahead and I still checked it out. I went to the company's website. This is put out by Roundhill Investments, and they have their Chat Generative AI and Technology ETF. At the top, they give us an overview of what this ETF is, and it says it is the world's first generative AI ETF. Chat is an actively managed ETF. That rings alarms for me too. I don't like actively managed ETFs, and it's because all it is on the other side of this is somebody picking stocks, and most people can't pick stocks. So there's some data from S&P Global, who puts out the S&P 500, and they're always showing us what percent of funds, active managed funds, are outperforming the S&P 500. I come to this website a lot to check data. So they have some data going for 1 year, 3 year, 5 year, 10 year, and 15 years. And it says percent of all large cap funds that underperform the S&P 500. We look at it on a 5-year basis, 86%. of funds underperform the S&P 500 over 5 years. That means only 13% of ETFs out there that are actively managed, like this Chat ETF, are actually outperforming. That's not great statistics. And whenever we go to 10 years, I'll click the 10-year button. It's about the same, 85% underperform. Whenever we go to 15 years, it's going up, 88% underperform. So it's around between 5 to 15 years, 80% of actively managed funds are underperforming. So I don't really like investments. I can't just buy and hold forever. I like buying and holding forever. I never like to think about the investment again. I just know it's going to make me money. And when it comes to actively managed ETFs, after 1 to 2 years, they just start to lose money. And you can't buy and hold forever. Could you make money trading this thing? Maybe. But I'm not a trading type of guy. I'm an investor. Now, going back to this ETF, it also shows us its top 5 holdings. And this is where I actually now just start to dislike this ETF. I think it's a robbery. We look at the top 5 holdings. It is NVIDIA, Google, which is Alphabet, Oracle, Meta, and Microsoft. All right. I mean, it doesn't really take a genius to choose these 5 stocks. I'll keep going down through the holdings here. We have their top holdings as of November 2nd, so just yesterday. Again, we got NVIDIA, Alphabet, AMD, Oracle, Microsoft, SoftBank, Broadcom, ARM Holdings, Meta Platforms. I'm not impressed. All they did was just go and choose the best performing stocks out there, throw them in an ETF, and we're in a massive bull market right now. So whenever it's up 150%, you could have chose any single one of these individual stocks and you'd be up 150% right now. They're not doing anything innovative or impressive over there at this place. And here's where it really starts to burn me about thinking about potentially getting into an ETF like this, is whenever we go up to see the cost that they charge to hold this ETF, because you can't just, someone who's actively managing this is a real person, a real investor out there that put this together and they want to be paid for their services. So we go to an expense ratio and it says they're charging 0.75% for you to hold this. If you were just to go buy Apple or Microsoft or Google, you wouldn't be charged anything to hold any one of those stocks. And all this company's doing is just getting the best performing stocks, throwing them in an ETF and saying, look how well we've done. But it's like, everyone's doing that. It's not impressive. And then they're charging you a fee on top of it. So right now, this company has $1.1 billion in assets under management, and they're charging 0.75% in an expense ratio. They're making $7.5 million a year just by grouping together the Magnificent Seven and then selling it to you. To me, it feels like robbery. And to compare what they're charging in an expense ratio compared to Vanguard, I pulled up Vanguard's Information Technology ETF, VGT. VGT has an expense ratio of 0.09 versus Chat ETF, which is 0.75. This company is just selling a marketing product. They are marketing you a product. They're trying to call it chat. They're trying to get you excited. They want you in on this thing because what they're trying to do is make money for themselves. They don't need this ETF to actually be good over the long term. They're going to make out with $7.5 million this year, maybe next year, maybe the year afterwards. As long as we're in a bull market, they're going to do good. And I've seen this story play out in the past already. When I think back to ARK Innovation ETF, Kathy Wood, whatever her last name was. I remember in 2020, there was an ETF, the ARK Innovation ETF, that blew up in terms of on the upside and the downside. And it was just all the craze. And she talked about innovation and technology and you're going to miss out on the next big wave. And I got a chart pulled up of the price of ARK Innovation ETF, the stock price, versus the inflows, the outflows and the inflows. So the amount of money that was coming into the ETF versus the amount of money that was coming out of the ETF. And we can see that in 2020, ARK ETF was trading at about $40 a share. And by 2021, it got up to $160 a share. It went up 300% in about a year's time. And from there, the inflows, we go down to the bottom, the inflows at the bottom we're barely getting over $100 million. Barely over $100 million worth of people's money was going into this fund. But by the end of 2020, going into 2021, it was getting over $3 billion. People like you and me were excited about this. The stock price was at $160, which is its all-time high. And retail investors were coming in at the very end and buying this thing at the very end, just putting tons of money in there. Over 2021 into 2022, we went into a pretty bad bear market. This ETF dropped 80% over 22 months, went from $160 down to $29 a share. There was no more money coming in there, just money coming out, money coming out, money coming out, all the way through 2024. The stock price kind of leveled out at about $40 a share, and still money continues to come out of this ETF. So I've seen this story play out before. This is a marketing strategy. What these fund investors do, these active investors do, is they just group together a bunch of high-flying tech names. They tell you that this is the next wave. Then they charge you a lot of money just to pay for the Magnificent Seven, and you can go out and buy it on your own if you want to. And I don't know, they're just selling you a product. Kathy Woods is a multi-millionaire, probably living in a super nice house, drives a really nice car, and she also had a 0.75% expense ratio for this fund. I don't know anybody who actually was making money in this thing, but she did. So I'm against it. I don't like Chat ETF. I'm against all actively managed ETFs out there. I'm not putting my money in this thing, but that's just me. So if you got any questions, be sure to send them to me at jacobbuildswealth@gmail.com. Give me a like, hit that subscribe button. I'll be back next Wednesday.